Welcome back, everyone. So I'm going to start today with an uncomfortable question. What actually happens to property when the economy goes bad? Because there's a huge gap between what people think happens and what actually plays out in the real world. And if you're an investor or just a homeowner, understanding that gap could mean the difference between making a great decision and making a very costly one. So in this episode, I'm laying the foundation on the entire series here. We're going to cover three things: what a recession actually is, what really drives property downturns, and why some states outperform others when things get tough. So let's go. Firstly, what is a recession? Most people have heard the technical definition, which is 2 consecutive quarters of negative GDP growth. That's it. That's the technical definition. But here's the thing. That definition tells you almost nothing about what you'll actually feel in your life. Because a recession isn't just a number on a government spreadsheet. It's job losses, it's businesses closing, it's people cutting back on spending, it's confidence collapsing. And all of that feeding on itself. When people feel uncertain about their income, they stop spending. When they stop spending, businesses make less money. When businesses make less money, they cut staff. And when people lose their jobs, they can't service their mortgages. And that's the cycle. And that cycle is actually what damages property markets, not the GDP itself. Okay? So let's put this in context for you. Australia has one of the most remarkable economic records in the world. For nearly 29 years, from 1991 all the way to 2020, Australia did not have a single recession. And that's extraordinary. No other developed economy came even close. But 2020 changed that. COVID triggered a short, sharp contraction, 2 quarters of negative growth, technically a recession. But what happened to property? It barely moved. In fact, within 12 months, most capital cities booming. Why? Because recessions don't automatically destroy property markets. The type of recession matters. The policy response matters. And the supply and demand dynamics, individual markets matter more than most people realize. What actually drives property downturns? So if recessions don't always hurt property, what does? So there are 5 key drivers. Number 1, unemployment. When people lose their jobs, they straight up can't pay mortgages. So there's forced selling increases, which increases supply, and buyer demand shrinks all at the same time. So that combination there pushes prices down. Number 2, credit tightening. In a serious downturn, banks get nervous. They tighten lending standards. Borrowing capacity shrinks. And even people who want to buy, they just can't get finance. Number 3, population decline. If people leave a city or region, whether it's due to job losses or migration slowdowns, rental demand falls, vacancy rates rise, and property values often soften. Number 4, oversupply. This one is huge, often underestimated. If a market is building too many new apartments or estates, and their demand suddenly stops, that oversupply amplifies the downturn dramatically. Number 5, investor exodus. Property markets have 2 types of buyers: owner occupiers, investors. In a downturn, investors tend to sell first. If a market is investor heavy, mass exit can tip prices much harder. So why do some states outperform others? And here's where it gets really interesting. Not all states react the same way in a downturn. And the reason comes down to 5 structural differences. Economic diversity. So a state that earns its money from 10 different industries is far more stable than one relied on 2 or 3. When one sector contracts, others can absorb that shock. Population momentum. So strong, consistent population growth means floor under housing demand. Even if sentiment weakens, people still need somewhere to live. 3, employment base. States with high concentrations of government employments, like the ACT, have naturally lower unemployment volatility. Public sector workers don't typically lose their jobs in a downturn. Supply constraints. If a market has limited land, strict zoning, and slow development pipelines, oversupply is less likely to become a problem. That scarcity protects prices. And finally, market valuation going in. A market that enters a downturn already at stretched valuations is far more vulnerable than one with genuine affordability headroom. So understanding the property market cycle is really important. So let me show you how all of this connects together. Property markets don't move in a straight line. They cycle. And every cycle has 4 broad phases. Boom, which is strong demand, rising prices, high construction activity. Peak, this is where price starts to plateau. Supply increases, confidence starts to waver. And then contraction. Demand falls, prices soften, some forced selling begins. And then recovery. Interest rates fall or stabilize, demand returns, and prices start to rise again. A recession typically hits during or accelerates the contraction phase. But here's the key insight here. Where a state is in the cycle when the recession hits determines how bad the correction is. A state that's already correcting and has affordable pricing is far less exposed than one that's been running hot for years. So understanding the role of interest rates now, there's one more factor we can't really ignore, and that is the interest rates. Because here's the paradox. Recessions are bad for property demand, but recessions usually trigger rate cuts, and rate cuts are very good for property demand. So what you often see is sentiments drop, prices dip slightly, but then the Reserve Bank cuts rates, borrowing capacities increase, and the market stabilizes or even bounces back. This is exactly what happened in 2020. The question is always, how deep does the contraction get before the rate cuts kick in? And how quickly does confidence return? So look, over the next 7 episodes, we're going to break down every single state, right? New South Wales, Victoria, Queensland, WA, NSA, Tasmania, and the ACT. For each one, we're going to answer 5 key questions. What drives that state's economy? What are its recession vulnerabilities? What typically happens to property values in a downturn? What happens to rents? Where are the opportunities? Because here's the thing, every downturn creates wealth for people who understand the market. The winners aren't the ones who predict the recession. They're the ones who understood which markets to be in and what to buy. So that starts in the next episode. We're kicking off with New South Wales, the biggest, most complex property market in Australia, and a market that has a very specific relationship with economic cycles that most investors completely misread. So don't miss it. We'll see you in the next episode.